So let's go ahead and get started. So first off and foremost, we obviously have our stocks and we have our ETF. Now, whenever you have a stock, it is simply just a single company. So let's just say, for example, we have our company right here called Apple. So of course, whenever we're pertaining to just stock, it is just going to be a single company that we see here. Whenever you have an ETF is basically a basket of stocks. So let's just say, for example, we have our nice little basket, which is right over here. And within this basket, we're going to have several different stocks. So let's just say, for example, we have one stock here, one stock here, one stock here. And these stocks could be, let's just say, for example, Apple, Microsoft, and Amazon. Now, the vast majority, we all definitely know what stocks are. That is probably the most common thing that we hear all the time. But a lot of us, we don't really know what an ETF is. So what an ETF, again, is simply just a basket of stocks. And whenever you ask me what is going to be the main way that you should be investing, especially if you're a beginner, the route that you want to go into is going to be this guy right here, which is an ETF. And the reason why is going to be because ETFs are just going to be much more reliable compared to single stocks. So let's just say, for example, we have our Apple stock, which is right over here. And then we have our ETF, let's just say, for example, VOO, which is going to be the same thing as the S&P 500, which also means that it is going to have some pretty famous companies such as Apple, Microsoft, and of course, our good old Amazon. Now let's just say, for example, on a single day, we have our Apple stock here. And what actually happens is that, let's just say, for example, this Apple stock had a really bad day. Say, for example, the stock probably dropped by 2% in a single day, which is pretty bad. Now going over to this side here, let's just say, for example, if VOO had a really bad day. Well, the really cool thing is, say, for example, our Apple stock, which is right over here, did go a negative 2% for the day, which is, again, pretty bad. But let's just say, for example, Microsoft had a pretty good day, and it probably went up by 3%. And then we have our Amazon, which is right over here, which, let's just say, for example, went up by 1%. So here's the magical thing about an ETF. Even though our Apple right over here had a really bad day today, your entire portfolio didn't do so bad because these other two companies kind of helped negate that negative 2% that Apple had. So when you do the math, what actually happened today was our total percentage was actually a positive 2%. So by the end of the day, let's just say, for example, if we had $1 million right over here, and if we had $1 million on this side, in VOO, again, we had negative 2% on this side, and over here we had a positive 2%. Our portfolio at the end of the day with our ETF is still going to be up by a good $20,000 versus on the opposite side, we're down to 80. So you can see that this is why we go with an ETF. Now granted, the opposite could be true as well. There could be a day where Apple is up by 2% and VOO could be the one that's having a bad day. So then Apple would be the one that is up by positive 20,000 for the day, and VOO would have been the one that's not doing so hot today. So yes, this is a scenario that could happen as well. So then what is the whole point of investing in either a stock or a ETF? Here's the thing. Whenever you are doing investments, you always want to do this thing called diversify. Diversifying your portfolio is something you want to do because, let's just say, for example, they always say it, if you put all your eggs in one basket, such as putting your whole portfolio into Apple versus an ETF, where again, we have those three other stocks, Amazon, Microsoft, and Apple. The benefit of, let's just say, for example, worst case scenario, if Apple were to crash, then you wouldn't be losing your whole portfolio because then you still have these two guys here to keep your portfolio right in the positive. So that is why in my book, the best way to start investing is going to be for a ETF. Because whenever you invest in an ETF, not only are you getting good diversification, but if you invest in the right one, say for example VOO, which is going to be a reflection of the S&P 500, you can be rest assured that this is going to be a much more safer bet versus just putting your eggs in one basket such as Apple. And of course, the whole point of investing too is to minimize risk and maximize return. So that is the reason why you'd want to go with the ETF, at least in my opinion. So yes, when you ask us what would we rather invest in, whether it's VOO, which again is the same thing as the S&P 500 if you don't already know, or would we just invest in single stocks such as Apple? What we would do is always just go with a more reliable ETF, because investing on this side you would be dealing with high risk by putting all your eggs in one basket. The single stocks are much more volatile, and what that means is that the stock can go up and down a whole lot. Now, the biggest thing on VOO side is that there's more diversification, more reliable, and it's going to be better for the long term because of those two reasons mentioned above, and many other reasons why. But yes, if you were on the fence of going into either single stocks or ETFs, we would highly recommend you go with the ETF and then watch how that grows. And then as you begin to learn more about stocks and finance itself, then you can go ahead and start doing single stocks. But even then, at the end of the day, it just makes a lot more sense to just invest in ETFs. Hope this video helped. If you guys had any other questions, write them down below. We'll be putting out much more videos. Thank you and have a great day.